is. Yazoo Kids uses a lactose-reduced milk that enhances flavour without adding sugar or artificial sweeteners. Milky deliciousness. And packed full of goodness. Very clever. Strawberry Yazoo Kids supports change for life. Yazoo, shake it up! Contains naturally occurring sugars. Milk is a source of calcium, which is needed for the maintenance of normal bones.
Whoa! Shell saltwater supercars. They look fun.
Science-fueled fun, actually, Dad. Toy cars that run on salt water.
Fuel the family fun with Shell Saltwater Supercars. Fill up with £30 or more and you'll qualify to buy a car from just $3.99.
I want one.
Okay, Dad.
Fill up on fun with Saltwater Supercars at Shell. Participating sites, conditions apply. See shell.co.uk/saltwater supercars for details.
Make sure you're uni-ready with our huge range of practical essentials and home-from-home comforts and get 10% off for a limited time. T's and C's and exclusions apply. Dunelm, the home of homes.
This summer at Chessington World of Adventures Resort, answer the call of the wild. With over 1,000 of the world's most amazing animals and over 40 of the wildest rides and attractions. Meet the Gruffalo and all your favourite characters at the Gruffalo Summer Party and so much more. Book early and save up to 40% at chessington.com. It's Britain's wildest adventure for all the family.
Later on the closing bell, UBS cutting its view on equities to underweight in light of the trade uncertainty. We'll speak with the firm's head of America's asset allocation about where you should be putting your money to work instead of stocks. After the bell, we're going to get another read, guys, on the consumer, retailers, PVH, Williams-Sonoma, Five Below, all reporting earnings. I'll see you at 3.
All right. But before that, we got to get to the half. Thanks for being with me today. Let's get it to Scott Wapner.
All right, John, thanks. I'm Scott Wapner, front and center this hour. The message of the markets. Recession signals flashing, bond yields falling, the trade war raging. Where is the best place to invest right now? It's 12 noon. This is the halftime report.
Is the countdown to a recession underway? And where do stocks go in the months ahead? The fear and uncertainty piling more pressure on Powell. Should the Fed cut rates next month? And how big should they go? A big call on JetBlue. Why the stock may be ready to take off. The investment committee is ready to go. The halftime report starts right now.
Welcome. Good to have you with us on this Wednesday. Our investment committee at the table today. Jim Leventhal, John Pete Najarian, and Brenda Vingello is the CIO of Sandhill Global Advisors. Adam Parker is the CEO of Trivariate Capital Management LP. We begin with the markets. Much of the focus today on that drop in bond yields. The 30-year hitting a record low. Some now saying the countdown clock for a recession has started. So, Pete, I turn to you, and I want you to answer the question I asked at the top. Where is the best place to invest? People want ideas.
Sure, and I still think the Burl Ives trade is still on. When I say that, I mean gold and silver. I mean, I know what we're seeing today, Scott, but some of these individual names are still moving to the upside. GLD, SLV, they've been a smart place to be over. If you go back to the end of May, that has been a great place to be. As a matter of fact, you look at the SLV, just in the last month, it's up about 10%, and I think it's still playing a little bit catch-up. But those are a little bit more on the conservative side. I think if you're really looking at the markets...
Yeah, you think? I mean, that's the best we got?
Well,
gold and silver
and 10% in a month isn't so bad. If you analyze that out, it's not so bad, right?
No, I hear you, but I mean, what you're saying is, I ask you, I don't hear tickers.
Oh, okay.
I hear gold and silver.
Oh, I'm excited. I'm excited to talk tickers early, bro. Let's do it. Yeah, I still think technology is the place to be. I still think there's all kinds of other places you could be. Energy today is really what sort of flipped. When we saw oil start to move to the upside, and we start to see this move in energy, how cheap have we gotten in some of these names? Look at Exxon. I own Exxon. I'm not happy about it trading underneath $70 a share, but I still think that those are possibility names that have plenty of room to run to the upside, Scott, if we hold or even increase a little bit more in the oil space.
Adam Parker, the former chief strategist, Morgan Stanley. So if you're posting a note this morning in your former life, what's the headline?
I like U.S. stocks. I mean, can we talk about U.S. stocks? Is that an asset class we're down with over here?
It's a great asset class.
This channel probably wouldn't exist if there wasn't a U.S. stock market. Right. I kind of like it.
Probably.
Yeah, probably. Right. Definitely would not. All of us would be elsewhere right now. I mean, look, the market trades at 16 times consensus forward estimates for next year. Let's say the real number 17 times. The estimates are too high like they always are. I think as long as you think earnings are growing next year, I have a 2% dividend yield. I got a buyback. I don't think we're seeing the kind of hubris from management teams that cause an earnings collapse. Typically you have too much catchbacks, too much inventory, too much hiring, too many, private planes to nowhere. I'm just not seeing that kind of corporate excess in the results I'm looking at. So I feel like earnings are probably going to grow. And to me, let's call it 16.5 times the real number for next year. Seems pretty good versus, what do you got, 1.5 on a 10-year or corporate bonds and other stuff. So I don't see why everyone has to always, call 17 of the last 0 recessions.
No, but if you're writing that note I asked you about, I bet you somewhere high up would be bond yields. Like, why are they falling? Well, what do you make of that? You wouldn't just dismiss that in your note, would you?
Listen, I read the outlook notes, from some of the major firms recently, from last Thanksgiving for this year. I think you had 4 hikes from one, you had 3 hikes from another. The inflation numbers, the economy, been roughly what people thought, and now they've got 2 or 3 cuts. So I think you know the answer. It's about people's interpretation of the Fed and interest rate environment. But equities, if you just look from here to there, have been fine, and I think you'll look forward, and as earnings grow, they'll continue to be a reasonable option.
Brenda, what do you think? That makes sense?
Yeah, I think we're getting a false signal from the bond market because rates are so low globally or negative across most of the developed world outside of the United States. But I think it's a little bit of a dangerous game to get too conservative and buy longer duration bonds here, because I think people are forgetting that inflation will materialize at some point. And I think in the United States, we've seen just recently that there was some signs that inflation is exceeding estimates. We saw some impact from tariffs. I think once we get into September, that's going to be more meaningful. And I think if anything gets the yield curve moving the other direction, that could be it. And it won't take much. I mean, if you're looking at a 30-year bond, just with a 50 basis point move higher, you're talking about a 15% loss in that position. So I think people are forgetting that there is interest rate risk in some of these longer duration bonds and just piling into treasuries because there aren't a lot of other alternatives with a yield.
So yield curve inversion doesn't matter?
Look, I think we have to...
You basically just made the case that it doesn't.
To get statistical significance, I think we would need another couple thousand years and several more examples of it for me to be super confident. And it's a bit of a chicken-egg debate on what's causing it. So I'm not saying it doesn't matter. You can look back, and several times that it's happened, it has been a problem. But I'm just saying the economy's clearly slowed if you look at major metrics from 6 months, 9 months ago. I think that's not really a debate if you look across a host of metrics. I think the debate is, will corporate earnings in the U.S. grow next year versus this year? And if they do, which I think is still the base case, I think U.S. equities will outperform.
What if they barely grow?
If they barely grow, I think it's still okay. I think if they start declining and people fear they're going to decline more materially, then you've got a problem and a reset. But remember, we've had, 10, 11 times the S&P's been down 10% or more this cycle, and what do you guys say on your channel? You buy that thing every time? I mean, by the dip, yeah, with the little...
It's your channel
little
too,
YouTube
Adam.
guy. Yeah.
It's your channel too now, all right? You're part of us.
I'm just saying, I don't see a reason to fear earnings are going to collapse outside of a huge economic slowdown that is no longer, to me, isn't quite yet in evidence.
Much ado about nothing, much to worry about. What is it?
All right, so it's not much ado about nothing. Maybe we're going to get a recession. I mean, the warning signals are there. But, Scott, I think the more important question, and you asked it at the top of the show, is what do you do? It's not that helpful to say, okay, we might get a recession 6 to 9 months out. The more important thing is, what has the stock market already reacted to? What has it overreacted to? This has been the most anticipated recession I've ever seen, and there's large sectors of this economy that are already pricing it in. So look at what's going on in financials, and we don't even have to name names. You can look at the top of the XLF, and it's all in a bear market. You can look at healthcare, okay? You can look at pharmaceuticals. You can look at CVS. These things are 20% off their high. Pete, I think you mentioned energy, okay? And you mentioned ExxonMobil. We can go around the horn. Royal Dutch Shell, Marathon Petroleum. I mean, some of these things are selling below book value. What's the point here, Scott? The stock market has anticipated, at least in sectors, has anticipated this recession more than anything. So you know what? Let's say we don't get the recession. Let's say that the bond market is wrong, Adam, okay? In that case, wouldn't I want to be in these things that have already been sold off 20% in anticipation of an event that's not going to come? Or if it does come, it's pre-disastered? I think of T.S. Garp, the movie, when the plane runs into the house, he says, we'll buy it. Why? Because it's been pre-disastered.
All right, Doc, how do you see it?
I think we've been driven down by the rates overseas, Scott, and that it is different this time because it's not the U.S. market that's screaming this, it's the rest of it pulling us down. I think that just as Rick Reeder said yesterday when he talked about the 10-year being the market and the 2-year being the Fed, he said, you got to hit that 2-year and hit it hard. And they haven't been. They've jawboned a little here and there. They haven't come out with strong forward guidance saying, for instance, we are going to drive this 2-year down to 0 or something like that. They haven't said that. Instead, they've just kind of dribbled out a little 25 basis point cut in July 31st. They're probably going to dribble out another one in September. It's the wrong move. Kashkari said in his op-ed a couple weeks ago, he said, boy, we should be using forward guidance a lot more than we are right now. They are silent after Jackson Hole. They should not be silent.
You want them talking like every day?
No, I want them to say in this September meeting, there is a better chance than you guys are pricing in that we're going to make a bigger move than you're pricing in right now.
All right, so Rick Reeder suggested he would like them to go 50.
Yes.
Do you think they cut rates in September?
I think
you painted a scenario in which they don't have to.
I don't think they should.
They don't have to for economic reasons. Yeah. They have to if you want to flip that yield curve back around.
Are we talking about whether they should or what we think they're going to do? I don't think those are the same things, and they haven't been for a long time. So,
what are they going to do?
It seems like the experts think they're going to do 25 basis points. But to be honest with you, the experts thought they were going to raise 100 a year ago. That was my point earlier. So I don't really, my process at my firm, I don't really care. Like I'm going to, go to the right parts of the market. If you get a bull flattener, I'm going to go find subcomponents of the market that I want to gross or net up and try to do well.
You don't want to have an environment, though, where the market believes that the Fed, there's already enough criticism of what the Fed has said and done. Right. That there's a great belief that the Fed is so far behind the curve, they just missed the whole story.
I'm not a big for criticizing the Fed. I always thought it was interesting that, even back with Bernanke, this guy's like a PhD with Princeton, a giant brain. He's looking at a lot of information, and all these 25-year-old kids on Wall Street with 2 years of experience are saying this guy's an idiot. Like I'm just saying, I'm not so sure they've made that many mistakes. Maybe they're a little behind, maybe they're not. The argument that rates are lower everywhere is certainly compelling. That could be drawing things down. I mean, to me, I think when you focus on the U.S., you have to look at what's going to cause the earnings to collapse. Earnings are kind of flat year over year this year. The economy's been growing, but okay.
I don't know, trade war, more tariffs?
Yeah, so
September 1st, but, right around the corner.
We talked about it when it was on your show a month ago. It seemed, like an apocalypse that day. The market's, 5% off its all-time high, and I think he tweeted, I think he got some calls, and then he didn't get the call. I mean, I just don't know how to handicap that stuff in the short term. I think if you follow what the companies are saying, it's not as good as it was 6 months ago, but it still looks like they're making some reasonable investments, and that earnings are going to grow. And if that's my base case, I think I'm going to get paid in U.S. equities over any of these other asset classes.
What if it's getting worse faster than you think? By the chaotic nature of everything.
Yeah, then in that case, I think the market will go lower. I'm not all the way where Jim is, where it's priced in. I wouldn't
sectors.
Maybe in certain parts always. But I would say if we're going to get an earnings decline of 10% or more, the stock market's going way lower. I think that's clear to me. But I just don't think you want to position yourself for that right now. That's wholly different than what I think some of the other guys are saying.
Interesting move today, though, right? You're up almost 200 on the Dow at a time when we're talking about the 30-year at a record low.
And started the day down 100, and then to flip around the way we did, Scott. We talk about volatility all the time. Volatility continues to be very volatile. I mean, take a look at where the VIX is today. Look at the range already. We were up well over 21. Now we're back into the lower 19s. I mean, Scott, the movement that we are getting on a daily basis is extraordinary, to be honest with you. And I think, we're all looking for opportunities out there on some of these sell-offs. I mean, earlier today, there were probably some great opportunities when we're down 100 points if you had any kind of a vision that we get this kind of a flip. But I think you have to remember, too, volumes are excruciatingly bad right now. And they have been, I brought that up for the last week or so, been really, really bad, really low, which is understandable. This is the end of August, the end of summer, all the rest of that kind of thing thrown in together. And I think folks are actually comforted by the fact that this market's kind of hovering around where it is, give or take, call it flat over the last couple of weeks.
There's also a reasonable explanation to your question about why, with bond yields going down, the market's up today. Because this economy, the U.S. economy, is hanging its hat on the U.S. consumer. That's all we've got. Forget CapEx. It's not happening. And the U.S. consumer is directly benefiting from lower interest rates. Now, MBA mortgage applications weren't great this week, but they were so big last week that that's an easy explanation for why they weren't so great this week. Car loans, mortgage refinancing, all of these things are coming through, and they're going to help the consumer consume more, which again is the peg on which this economy rests its hat.
Scott, when you look at the volumes that Pete just cited, and with Bill Griffith, I think you were listening when we were talking about that, Bill and I on the side, You look at Tiffany's today. Stock opened up 3 or 4% as soon as those earnings hit the tape. That's up 3 or 4%, about $3.40. Flips when the CEO comes on and says, yeah, even though things were great in China, Hong Kong was a real problem. We missed at least 6 full days. We're going to miss more. And the thing flips from being up 3 or 4% to down 4%. And then they catch a bunch of shorts right there. To Pete's point about volume, Scott, and where are you going to get it? All those 11 or 12% short interest came scrambling in trying to cover, and they drove it up. And you look at where Tiffany is right now, it's like an EKG.
Up 3.5%.
Yeah, that's because of that lack of volume.
Don't chase that. I agree.
Don't chase that, all right? 4 years ago when China devalued and set up about a 6-month period in the markets that were terrible, I remember Tiffany's then had one earnings report that, I think it was right around this time, that did well, and then it just slid for the rest of the time. China is very important to Tiffany's. You can't underestimate that.
But they were saying they were good in China, and my point, I guess, Jim, was that then they cited the events in Hong Kong and how much it's affected their sales, stores, people unable to get there and all the rest. And then when everybody wanted to come in and say, I'm going to buy back a little of those nice shorts I got on,
just don't
there was nothing offered.
Don't chase the shorts, though. Don't get sucked in by short covering.
Volume is tight.
Let's get some more on the state of the markets right now. Bring in our next guest, Jim O'Neill. He is the former chairman of Goldman Sachs Asset Management, former commercial secretary to the Treasury in Britain, and currently leads the British think tank Chatham House. He's on the phone with us. Mr. O'Neill, welcome back. It's great to have your voice on our program today.
Thanks for having me on.
Yeah, what do you think about the current environment?
I listened to that discussion you guys were just having. I mean, I guess the strongest thing to be said for the market, not that I follow it as closely as I once did, is that there's a lot of things to worry about. That is for sure. I historically have generally been somebody with a more optimistic air for the best part of the last 2 decades. But there's a lot of things that are troubling out there, especially outside the States. But in my opinion, more inside the States than I often hear people in the US talk about, partly because of this very strange character that you have as your president.
We'll get to our president in a moment. Let me ask you about bond yields. What is the message in the continued drop in yields? We have one of our panelists today suggesting that it's sending, quote, a false signal, just simply because of the fact that yields are negative in so many different places around the world. What do you see?
So I don't know whether it's false. It's sending a very powerful signal, but what is intriguing, and I think I heard one of your guests saying that, I mean, why should that signal be false? I mean, it could be, and if we get massive fiscal stimulus in Germany and more fiscal stimulus in China, and Trump manages to somehow come up with more fiscal stimulus, all of that could mean that bond yields suddenly rise sharply in many places. But the fact that you've got such low yields in the US, you've got an inverted curve, you've got amazingly negative yields in so many growing parts of the rest of the world, it's kind of pretty scary in my view, because the markets appear to be saying that they don't see an end to this constant battle with trying to stop deflationary pressures and something close to a recession in many parts of the world. And of course it could be false, but that's the message that is kind of being sent.
Do you worry about a recession in the United States maybe sooner than some people think?
I do, yes. I think if you look at the areas of weakness of the U.S. economy, it's essentially business fixed investment spending and exports. They have absolutely no chance of improving until Trump gets over his very erratic love affair with trade tariffs, which doesn't look like it's happening anytime soon, or you guys as a country get over your love affair with Trump. And the economy's strength in the meantime depends so much on consumption, which is fine unless financial conditions tighten unexpectedly when a lot of indebted U.S. consumers won't be able to afford to keep up the consumption they're doing.
Yeah.
And I suspect the yield curve is partly sending that message.
How do you see the trade war playing out?
If what I've said starts to show up more in the U.S. domestic data, and I'm not sure how easy this would be for Trump and his colleagues, given how stuck in they are on this approach, but they seem to flip-flop a lot on other things. I think, given that 2020 is an election year, and as we all know historically, is the economy stupid, he would have to change his whole strategy and somehow come to a conclusion that trying to pursue tariffs with, currently China, but no doubt at other moments other countries, is just simply not a smart thing which is likely to benefit the US. And if he did that, and there was some confidence that it was going to be a persistent change, I think there would be an enormous relief around the world, and there'd be a big recovery in global trade. And with it, we'd start to see a pickup in U.S. exports and investment. But without that, the U.S. economy is increasingly riskily dependent on an over-levered consumer. It's like, on some ways, it's like 2008.
Yeah, therein lies sort of the issue with the Fed is the Fed has to game this whole thing out, worried about a more dramatic slowdown in the U.S., against a backdrop that seems to be pretty good right now. If you get any kind of development or movement like you just suggested in trade, the picture can brighten maybe quicker than people expect. If you're Jay Powell, what do you do in this environment?
Make sure I've got some good sleeping tablets, I think. I think it's tricky, and I've seen reference the past 24 hours to the article that my old long time ago colleague Bill Dudley wrote. I think Bill's kind of right. I mean, on one level, for the Fed to be essentially responding to structural bad policies from the government is in itself making it trickier. But that said, I quickly turn to supporting Jay Powell because the Fed's got a mandate from Congress which links to growth and inflation. And if the economy is weakening and inflation is softening, then the Fed has to respond. But if I were in his shoes, I would highlight that perhaps markets should have somehow tried to price in more optionality to what the interest rate outlook might be in the next 12 to 24 months, because I do think the current pricing of the Eurodollar futures and the implicit Fed cuts could turn out to be very wrong, but that would have to be dependent on Trump abandoning this almost kamikaze strategy that he's embarked on.
Yeah, I mean, you mentioned the Dudley op-ed, which has gotten a lot of talk over the last 24 hours. You'd admit probably it's not exactly the Fed's job to decide which policies it likes and which ones it doesn't, and which it should react to and which it shouldn't.
No, I agree with that. I agree with how you've stated it. But funnily enough, I published something through Project Syndicate about a fortnight ago, which is tangential to the underlying theme of Dudley's. It really relates to aspects of financial conditions. The Trump strategy appears to be hugely dependent on an easing in the interest rate part of monetary conditions, both short rates and bond yields. And that, of course, the Fed would have to do if the economy is slowing, and in that sense you're right. But in terms of it really helping the U.S. economy, the theme I increasingly suspect is I think the U.S. economy is becoming asymmetrically dependent on financial conditions, i.e. A little bit more easing in the domestic interest rate part of it might give some support to the economy. But whenever financial conditions tighten, whichever form of tightening they are, and God forbid, if it were now through higher bond yields and short rates, I think the U.S. economy would be extremely sensitive to that. And I could imagine Fed policymakers probably think the same, and they're probably very worried about it. But you're right. At the end of the day, they are what they are, and they're democratically mandated by Congress if semi-independent. So they have to respond to the evidence that's there.
Sure. John Najarian has a question for you, Mr. O'Neill.
Jim, great to have you on. Thank you, sir. Quick question regarding the observations you're making. So they sound fairly pessimistic. Are you putting your money where your mouth is on any of those, or are you just publishing?
Well, my investments are all done in a trust which is managed on my behalf. So put it like this: if I were in charge completely of it, I'd make sure I had quite a bit of cash. I think against that, I think I guess what I really suspect we are coming to the end of is the sort of broad mass simplistic moves of so many markets together. And I would imagine for sector pickers and stock pickers, it's probably going to get a bit more interesting. But the sort of easy, simplistic ride of low vol related trades is obviously kind of over. And insofar as I can give guidance to my trust, which I do, that's the kind of guidance I give.
Let me ask you lastly before I let you run. Brexit. How concerned should we be about what may take place in the UK?
If you could have any confidence about what today's outlook for Brexit will be in a week's time, then it would be easier. But Parliament is just about to come back in the UK after a summer recess, and I think even though we have a new Prime Minister, I suspect we're going to go through the whole complex paraphernalia that we did with many months with Theresa May, and it's not obvious to me what is going to happen. Clearly, we have a Prime Minister that's very loudly making it clear that he intends to take us out on the 31st with or without a deal. But I suspect we're going to see in the next week that Parliament is going to make that very difficult for him to do. But in the event of the UK leaving on the 31st of October with no deal, that would definitely be bad for the UK, and I think it would add a further element of weakness to obvious places in Europe, Ireland and Germany in particular, on top of a European economy which has weakened sharply in recent weeks, both for domestic reasons in some places, but also linked to the big slowdown going on in China.
I'm assuming that you've seen the news about Parliament being suspended in September as well. I just want to make sure you've seen that.
Yeah, I have. Yeah, of course I have. But Parliament has a week starting early next week to try and make life very difficult for Boris before Parliament is suspended. So. They may right now. All those that wanting to take over parliamentary business, which is what they'd all agreed just today, will be accelerating their plans to try and do that next week. So there may well be some legal thing they put to the table next week, which would make it very difficult for Johnson to do what he wants, even if he does suspend Parliament. So. But the only thing I would guarantee for you is that what appears to be the likely path on any one day in the next week won't seem the same the following day.
Yeah, the only guarantee is there is no guarantee these days, and who knows, just about anything. Jim, thanks. It's great to talk to you today.
All right. Thanks for having me on, guys.
All right, that's Jim O'Neill joining us. We're going to take a quick break. Lots to discuss on the other side. Here's what else is coming up on the Halftime Report.
Feeling fly? Why, Deutsche Bank says buy JetBlue on the back of its double-digit drop in the past month. It's our call of the day. Plus, the desk is ready to answer your questions. You can reach us on cnbc.com/halftime or tweet us at Halftime Report using the hashtag AskHalftime. The Halftime Report with Scott Wapner and the Investment Committee is back in 2 minutes.
When I lost my sight,
the new Vauxhall Combo Cargo delivers. For the heavy lifters with its payload of up to a ton. For the fuel savers with its highly efficient engines. And it delivers awards, including International Van of the Year 2019. New Combo Cargo. Carries British business. From 168 a month with 6 years 0% APR. Vauxhall. British brand since 1903. Conditional sale. Minimum 18% deposit plus VAT at 20% on total price. Financed by Vauxhall Finance, subject to status. 18 plus. Small business users only. T's and C's apply. Search combo offer.
Live big and spend less on the brands you adore. And dine by the waterside. Who could want more? Lap up the savings as much as the view. With Ted Baker, Hackett, Nike and Coach too. Lock Fine and Five Guys make it a date. You can shop, meet and eat every weekday till late. So sit back, unwind, and let style lead the way. And give yourself a different day. At Gunwharf Quays. Waterfront outlet shopping.
Did you know Currys PC World do business? Saving your business up to 30% with mega deals. On computers and printers, electricals, large screen TVs, and even more. Top brands like HP, Microsoft, Epson, Sony. And if you find it cheaper from any major retailer, we'll match it. Get these deals before they're gone. Must end soon. Visit your nearest store or pcworldbusiness.co.uk/megadeals. T's and C's apply. Excludes Inc. and third-party sellers. Visit website for price promise details. Claim within 7 days.
I didn't choose you. You chose me. When you broke from the crowd and pawed at my knee. Soon you'll be feeling right at home. You'll be a bit unsure, but you're free to roam. What's good to chew? What's nice to nibble? Wet food, dry food, tin food, kibble? You might sometimes be cheeky, not always wise. But I know I found love in those puppy dog eyes. Join the free VIP Puppy Club from Pets at Home for advice and exclusive offers, including 10% off your first shop in store. Visit petsathome.com/puppy club or join in store. T's and C's apply.
Strings and things. Strings and things. Strings and things. Strings and things. Strings and things and strings, strings, strings and things. Strings, strings, strings and things. Strings, strings, strings and things. Strings and
Now there's a whole range of strings and things called strings and things, including cheese strings, yollies, and new cheese shapes. Find them all in the cheese and yogurt aisle.
Strings and things. There's your market picture at just about 12:30 on the East Coast today. The Dow is up by nearly 200. S&P and NASDAQ, while the Russell's the outperformer, 1 1/3%. All this on a day where there's big focus on bonds and yields and falling yields. Yet again, the 30-year hitting a record low today, and nonetheless, at this moment, stocks are higher. Let's go to Kayla Tausche with a news alert on the trade war. See if maybe stocks are still higher when Kayla's done. Kayla.
Hey, Scott, just days before this new set of tariffs kicks in, business groups from a wide variety of industries are now calling on President Trump to delay them. In a letter sent today, 161 industry associations ranging from the blue chip U.S.-China Business Council to those representing more niche exports like RVs, greeting cards, lobster. They're all criticizing the White House's lack of warning. They say China is still someplace that they have to do business. Leaving there is unrealistic, and that there will still be an economic impact even with some of these tariffs delayed until December. Now, the coalition called Americans for Free Trade notes that the $112 billion in goods that will be hit with new tariffs includes 92% of all apparel and half of all footwear. We should note, though, these business groups pleaded with the administration back in May. There were tariffs that did go into effect on June 1st, and then a truce after that. A U.S. trade representative has already submitted a filing with the Federal Register to make this 15% tariff effective for goods that leave China on